So, what lessons can investors take from these results about the broader economy or the tech industry? Joining us now is Mark Mahaney, Evercore ISI, head of internet research. Mark, I want to ask you particularly to begin about Duolingo and DoorDash, because I saw a common theme running between those two. Duolingo, which I know is a favorite of yours, saying, look, we're going to shift the balance between investing in growth and product quality away from letting money flow through to the profit line. DoorDash, in a way, doing something similar, saying they're going to unify their platform across those three properties, DoorDash, Volt, Deliveroo, for AI, and do some other things operationally for the long term. Investors didn't seem to like that.
You know, I'd spin it another way, or similar to what you just did, John. Investors don't like investment cycles. So I think that's the case with Meta, Dash, Duolingo, Uber. I think there's a few other names in there too, maybe Pinterest. You know, all those companies that went into and out of this earnings cycle and sort of negatively surprised the market by saying we really want to lean into investments first. And I think DoorDash is, you know, to me, it's kind of like you just can't be that surprised. They just closed the deal with Deliveroo. They bought the asset to invest in, to regrow it, and yet the market didn't like it and sold off the stock aggressively. The good news, though, so that to me is kind of the common theme here. The good news is investors, yeah, you don't want to buy a stock before they announce the investment cycle. But if you believe that it's a good investment cycle, this is your clearing event. This is your chance to get in on a stock. DoorDash hasn't been one of my top longs. It's been a long for us. Hasn't been a top long, but you know, it's something I got to seriously consider now. You've got the bad news out of the way. And what's happened, you know, there's been some reports about consumer flagging. You're not seeing it from DoorDash. You're not seeing it, and by the way, in the travel names either. Airbnb, I mean, the demand was better than expected and intrinsically strong across all the travel names that I look at, and for DoorDash too. So I like DoorDash here. I understand the investment cycle risk, but guess what? That's behind us now.
Investors don't seem to care so much about investing in AI if you're doing it through data centers and buying NVIDIA chips. I mean, not to say they don't care at all, but a lot of the hyperscalers and mega cap tech seems to be getting more of a pass here. And I wonder if you think that there's even more of a bifurcation now between how some of these software names are doing and what some of the valuations and expectations for the really big names are.
Well, that's a loaded question, John. I'm going to do my best at it. It depends where you start with valuations. And the advantage you've had with a name like a Google or a Meta is that they start off at like 21, 22 times earnings, kind of like at a market multiple for what I think are kind of tech staples with just a lot of good, interesting growth opportunities ahead of them. So there's not that much downside risk in those names, I don't think. And then the question is, are there other stories? I'll just correct one thing you said, which is that I think one of the reasons that Google is actually sort of the outlier here and is outperforming the market in this is not just because it's buying NVIDIA chips, but it's because they're diversifying away and they've got their own chips, TPUs, that the market's actually pretty bullish on, and they're just starting to vend this. So all of a sudden, you got a full tech stack, tech name like Google that's showing you chips. Nobody ever talked about Google as a chip company before, and now that's entered into it. So that's part of the levitation of Google shares.
I use DoorDash as a metaphor when I'm explaining agents to people, right? Like you used to go to the restaurant yourself, but now you can send your agents there to bring the experience to you. For these service companies, and I'll throw Airbnb in there, Uber as well, is AI more of a threat or is it more of an accelerant? Do you see them being the place where people go to get this efficiency deployed, or do you see something like OpenAI, Anthropic, et cetera, becoming the interface, coming on over them and commoditizing them?
I don't think they'll come over them. I don't think they'll commoditize them because you got to get physical logistics right if you're doing delivery. I'm sorry. It's now the what could go over the top on a name like Uber is physical manifestation of AI, i.e. robo-taxis. I'm of the belief that they'll actually be one of the winners because their network is so strong, their demand network is so strong, large, and they're going to have multiple AV vendors, robo-taxi companies to work with. I may be wrong on that, but that's our point of view. I'm really intrigued, though, John, by what AI could do to increase personalization for e-commerce companies, travel companies. I mean, I think that's where there's real upside. Jassy talked about this at the end of the Amazon earnings call call, and that, it's been kind of sparked an idea I've been kind of mulling for a while. I think there's a lot of opportunities to improve, and you could kind of see this inflection, I think, in online retail sales growth, online travel. If you make that product, that service a lot better, that's become a little bit commoditized. But if you can go in there and really say, hey, I'm looking for Hoka shoes, but I'd like something that's a little less expensive, but with a similar functionality, like to have that kind of conversation with a bot, with either ChatGPT, Gemini, or Amazon, and they'll get you to good shoes. That's a level up of online retail experience. And I think that's what we're going to have happen to us.